Okay, let's talk about today's job report and an unemployment number and what it means for the economy and for investors. In January, the US added about 130,000 jobs, which is a little better than economists were expecting. And in fact, it's twice what expectations were. And the unemployment rate ticked down to 4.3% from 4.4%. Now, it's not the roaring labor market we had right after the pandemic, but it still points to an economy that's growing, not shrinking. Most of the strength was in service industries like healthcare, social assistance, and it's also worth quickly clarifying what these numbers actually mean. The unemployment rate comes from a monthly survey of households, and to be counted as unemployed, you have to be out of work, available to work, and actively looking for a job in the last 4 weeks. If you've stopped looking or you're retired or in school, you're not a part of that rate. The job growth number, on the other hand, comes from a separate survey of employers, which tracks how many people are on company payrolls as well as things like hours and wages. So when you hear payrolls added 130,000 jobs, that's coming from businesses, not households. Now, let's zoom out a little bit. This report lands in a pretty specific macro environment. Through 2025, we saw job growth cool off quite a bit, and revisions to the data showed the labor market just wasn't as strong as it originally looked. The unemployment rate has moved up from the mid threes to the mid fours, and we're seeing more people unemployed for longer and more folks working part-time because they can't find full-time work. And it seems like that's more of a slow easing rather than a sudden break. And on top of that, you have structural forces like slower labor force growth, tighter immigration and technology, AI included, meaning the economy may simply need fewer jobs each month to keep unemployment roughly steady. There is one important caveat here that I think it's important to mention, right? These numbers have been less reliable than usual recently. Once a year, the government goes back and lines up its payroll figures with the complete tax records. This time around, that process removed a pretty large chunk of the job growth that we thought we had in 24 and 25. And it was to the order of hundreds of thousands, if not close to 1 million jobs, which pushed the average monthly job gain last year down to roughly flat. Now, by no means does that mean today's report is useless, but it does mean that we shouldn't put too much weight on any single month. It's better to watch the trend over several reports and kind of cross-check that with other indicators like jobless claims, business surveys, and what companies are saying in their earnings reports. So what does all this mean for markets? A 4.3% unemployment rate with moderate job gains above expectations is consistent with an economy that's still expanding, just at a slower, more sustainable pace. And because this report came in a little bit better than expected and unemployment dropped, I think markets are likely to lean towards fewer or later Fed rate cuts, which tends to mean that you're going to see slightly elevated bond yields or bond yields that aren't falling, so you won't see the price appreciation that you may have expected to have in bonds. It all kind of boils down to the labor market isn't red hot, but it's not breaking either. We've cooled from where we were. Some of the earlier strength has been revised away, but the economy is still creating jobs. It's still supporting income growth. So that backdrop may not be nearly as exciting as it has been in the past couple of years, but I think it's a more reasonable environment to grow.